Mike Moore Media.
Hey folks, this is JR with Liberty Tax Service of Rockingham County. We help cover the offices there in Reedsville and Eden. The one in Reedsville is on U.S. Highway 29. Address is 5200 U.S. Highway 29, right there across from Lowe's Home Improvement. The one in Eden is right there on Highway 14, right next door to Wells Fargo. I've been with Liberty Tax about 11 years here in Rockingham County, 13 total. So just wanted to reach out this morning and talk about some of the changes of tax season. You know, there's that old adage out there, the old quote that says there's only three certainties in life. That's change, taxes, and death. Well, I'm here to cover two of those, which is the changes to the tax system, some of the big changes that we had this year, and if we have enough time, we'll get into some of the changes for next year. But one of the first things I wanted to talk about, which can help people immensely, is they got rid of the penalty for any overpayment of the advance premium tax credit. And so if you don't understand tax talk, I'm going to kind of break that down into layman's terms. So remember back, Affordable Care Act. The Affordable Care Act is a way that people can get help paying for health insurance. And they get that help in the form of an advanced tax credit, or a tax credit that helps pay some of your health insurance premiums. We call it the advanced premium tax credit. And so one of the, in my personal opinions, flaws with that is that you get the credit based upon what you think you're going to make next year, or what your total income will be on next year's tax return. And that's hard for some of us to judge. Some of us are on salary, so we might think that's pretty simple, straightforward. But what happens if you hit that scratch-off ticket? What happens if you inherit some money? What happens if you get an unexpected bonus at work? All these things can change your income, so that tax credit that you said, hey, I'm going to make $40,000, that's my salary. If you get another $5,000 that you didn't expect, that can lower the amount of premium tax credit that you should have qualified for. So that means you owe back a small amount of that tax credit. And it's not necessarily a penalty, it's just a reconciliation of that tax credit. And anyone that received an overpayment can pay back a small portion. It is limited by income sometimes, the amount that they want you to pay back. But you could be expected to pay back all of the advanced premium tax credit if you go over a certain income amount, which is typically around that 400% federal poverty level. So one of the big things they did, because nobody knew what their income was going to be this year with COVID, in tax terms, we always think of this year as last year, because we're always doing tax returns for the prior year. So this past year, during COVID, no one knew what their income was going to be. And so it was enthralled with changes. Drew unemployment. I cashed in retirement. I worked extra hours because everybody else got sick. Your income could have changed greatly last year. And so if you were on an Affordable Care Act plan or had Obamacare through the marketplace, that advanced premium tax credit, you might not qualify for as much as your health insurance agent forecasted because the change of your income. So one of the changes they did was no payback of the advanced premium tax credit. And that saved, I have a client, went 1 year, they were out sick from work. Him and his wife both work. Actually, she's on disability, but she has a little part-time job. And then the other client, he got a huge opportunity in the workplace, and then also started a part-time job. So their income changed greatly. Well, they get about $800 a month helping pay for their health insurance. And so if it wasn't for this new tax change, this new tax rule, they would have had to pay back close to $9,000 of advanced premium tax credit, which they were not prepared for. So this rule does help some of these people that their income changed greatly. If your income goes up, there's no payback of the advanced premium tax credit. And so that was one of the big changes this year. If you had Obamacare and you filed taxes this year, I would highly recommend that you, if you didn't already, get in front of a tax preparer or someone that can review your tax return to make for sure that you didn't pay back that advanced premium tax credit. If so, you might want to take some action to help avoid that. Another big change this year, and there's a lot of confusion around this one, was retirement account withdrawals. Retirement account withdrawals. A lot of people heard, even in the workplace, it was, hey, COVID hit, you can get money out of retirement. And that was all they said. They didn't give any more details above and beyond that. They just said, oh, here, sign here, you can get money out of retirement. And so it's not that straightforward. It's not that plain and simple. It's not that clean. The retirement account withdrawals were only available to you if you were affected by COVID. That's the key element. And yes, you can go ahead and argue and justify that all of us were affected by COVID, but the IRS laid out some specific scenarios on where you would have to prove that you were affected by COVID. So the first one is if you were diagnosed with COVID yourself. If you contracted COVID, you could say, yes, 100%, I was affected by COVID. I can withdraw from retirement up to $100,000 without paying a penalty. And also, I want to be clear on that. That doesn't mean you get to avoid taxes on that money. That just means you get to avoid that little 10% penalty that a lot of us would be affected by if we cashed in retirement early. Second bullet point on where we might be affected by COVID is if your spouse or your dependent was diagnosed with the SARS-CoV-19 virus. So if you, spouse, dependent, any of you contracted COVID, that kind of opens up that window where you can withdraw from retirement and avoid that 10% penalty. Another one would be adverse financial consequences as a result of being quarantined, furloughed, or laid off, or even having your work hours reduced due to COVID. A lot of people could say, well, yeah, my work hours were reduced, or my situation changed, or whatnot. On this one, I would encourage all of my folks, if they want to take this route, make for sure that you would be confident your employer would write you a letter stating that you were affected. You were either furloughed, laid off, or had work hours reduced due to COVID. That would be kind of the proof the IRS would look for if they ever reviewed or audited your situation and asked you why you qualified to take retirement money out early. There's also another bullet point. If you experienced adverse financial consequences as a result of not being able to work due to lack of child care. Now, remember back when COVID started, a lot of daycares shut down. A lot of resources for parents to have their kids cared for while they were working got restricted. So if you didn't have daycare, that would be another justification. But again, make for sure anytime we report something on the tax return, it's always something that you want to be able to prove or justify in the IRS's eyes. So make for sure that you would have the daycare that would back you up saying, yes, we closed down, we weren't able to watch their kid due to the COVID. Another one would be just reduced hours or being laid off because the business closed during COVID. That would be another scenario of where you would qualify to have this retirement account money withdrawn and avoid the 10% penalty. Again, you would not avoid taxes on this, and that can throw people for a loop. If they're used to making $30,000 a year and then you go withdraw $70,000 from retirement, puts you in a much higher tax bracket. It can have some other consequences. If, say, your spouse is on disability, it could cause that up to 85% of that income to be taxable. So before you make any large transactions like that, of course this was for last year, but anytime you have any questions or making a large financial transaction, it is good to ask your tax preparer, whether that's us at Liberty or the person that you've been using. Ask them before you withdraw from retirement is always my recommendation. Another more commonly known rule that came out, or exception that came out during COVID on this tax season, was the first $10,200 of unemployment was deemed not taxable on your federal tax return. And that's where some of the confusion come in. A lot of people said, oh, it's just not taxable, period. No, that is not the case. The IRS said they're not going to tax it But North Carolina State, they were what's called a non-conforming state with that rule. They still want to tax that unemployment income. Every dollar that you received, whether you got $50 in unemployment or $35,000 in unemployment, they're still taxing all of it, including the first $10,200 that the federal said they weren't not going to tax. So that kind of shocked folks, because in the beginning, back when unemployment came out and they added the extra $600 above and beyond the state amount that you would have qualified for, it was advertised very heavily that this will not be taxable, quote unquote, right? But when they come and did their taxes back in January, that rule had not been implemented. The IRS was still going to tax that $10,200. It wasn't until later in tax season, I believe it was mid-March, before they finally came out and said, hey, this is not taxable. The first $10,200 we need to pull back out of your taxable income, your adjusted gross income. And then we had to wait, it felt like forever, but it was another week and a half, I believe, until North Carolina came out and said, you know what, we're still taxing it. So then after that, we had to wait on the software providers to get approved software from the IRS and Department of Revenue so that we could report your unemployment accurately. So that $10,200 of unemployment, yes, it will not be taxed. Again, that kind of shocked folks when they went to file taxes, or there's confusion during tax season, which is one of the reasons they extended tax season to May due to the changes and the changes in software they had to mess with. And so that unemployment was big news, big talk, big confusion, all the above. So again, North Carolina still wanting to tax it. We had to wait on guidance from North Carolina. And oftentimes that ended up making people owe taxes for the first time in a long time, especially on their state tax return, because they thought that none of it would be taxable. So they didn't have withholdings as they could have or should have. So that was one of the big things this year, was the unemployment. Oh, to follow up on that, the IRS has said that they're going to, again, I'm using air quotes, automatically adjust for those people that had already reported unemployment. So if you filed in January or February and you had unemployment on your tax return, there's a good chance you paid more in tax than you should have. IRS, in their wisdom, says that they're going to fix that. They're going to adjust that. I'm encouraging all of my clients, and I would encourage any of you that drew unemployment, to, when that adjustment comes out, they're supposed to start mailing that out in May. But it could be several months before they get to everyone. But when that automatic adjustment comes out, when that extra check shows up in your account, contact your tax preparer. Make for sure you got that right amount. Because it's not just reducing the tax liability that unemployment could do. With the effect that it had on the adjusted gross income, it could also change your earned income credit, child tax credit. I would make for sure, once you get that adjustment from the IRS, that you double check their numbers, double check their math to see if there's any credits that might have been affected. If so, that's when you do an amendment. The IRS has given guidance right now that you should not send in an amendment to update your tax return with the adjustment of the first $10,200 of unemployment. They don't want your amendments. They said they're going to handle it. But if when they send you that check, it's not the right amount, then you can take action. So that's a lot of things around unemployment that could be affected on your tax return. Again, contact us. This is JR with Liberty Tax of Rockingham County. I help cover the Reedsville and Eden locations. Be more than happy to give a 20-minute sit-down with anyone that wants to go over their tax return. We'll do a free double check, do a free review, make for sure you got what you were entitled to from the IRS. And so one last thing I want to hit on is charitable. Years past, standard deduction has gone up and you haven't been able to claim charitable. You probably will be able to claim it this year, so make for sure you take at least $300 of charitable receipts into your tax preparer when you're going to file. It can help you out. We want to get you every dollar we can. Again, this is JR with Liberty Tax.